Hey guys, welcome to State and Local Taxation Directed Study Part 1. My group's doing sales and bulk tax, and I'm going to lead off today with the Introduction to Sales Tax. As I would assume everyone knows, we've all dealt with sales tax at one point or another in our lives, buying things. As of right now, 45 states and the District of Columbia impose a sales tax on their purchases, and it's important in their fiscal policy for income. The only states that don't impose it are Alaska, Delaware, Montana, New Hampshire, and Oregon. Also, local jurisdictions besides the state themselves do and can impose sales tax as well. So if you've gone north of New Hampshire, you might have enjoyed some shopping that is free of sales tax in the state's fiscal policy. So, as I said before, it's very important for the sales tax to be imposed in these states because it's a big source of their income. The numbers I had were from '95 that said roughly 35% of all the revenue that states collected was from the sales tax. I looked up more modern numbers, and I didn't put them up here because they weren't definitive, but it's still roughly 35% or a third of the state's budget, or income that they collect comes from the sales tax. And as you see on the slide, $135 billion in '95 was raised through the sales tax. And that didn't count local government, just the state as a whole. Obviously, Massachusetts is a state that imposes an income tax, but for states that don't impose an income tax, this sales tax can be very, very important for revenue for the states. And I have a few examples. Florida, Tennessee, and Texas are both in the high 50s, if not 60% of that state's revenue comes from sales tax. So, like I said, Florida, Tennessee, Texas, I just have an example of an imposed sales tax. This one's the one from Texas, and it says a tax imposed on each sale of taxable item in the state. The sales tax rate is 6.25% of the sales price of the taxable item sold. Now, that's the same as Massachusetts, if people are familiar, 6.25%. And these can vary. I live closer to New York, so I could tell you New York has a higher sales tax than Massachusetts, but again, New Hampshire has none. So, I mean, you could, I guess, shop around your local states if you wanted to try and find a cheaper sales tax than the one you're paying currently at the moment. And so, tax will refer to sales and/or use tax in this presentation from here on out, unless it says or I say otherwise. So, I've already gone over what a sales tax is, but to be more definition-based, sales tax is a transaction tax that is imposed on intrastate retail transactions, calculated as a percentage of the price paid for taxable goods and services, and also it is able to be imposed on either the seller or the purchaser. So we're used to it as the purchaser being imposed on us when we buy certain items, but there are times when we can be exempt from tax. An example of that would be like a business. They have a tax ID number from the state, so when they buy things for their business, they don't have to pay a tax. So there are different things that are exempt or included in the tax, and there are just some key terms about all of them, and I'll go through them slowly just to kind of give you guys a basic understanding of everything. So a sale, this is kind of 101, but a sale typically includes the following transactions when occurring for consideration. The transfer of title to or possession of a taxable, tangible personal property, or the exchange, barter, lease, or rental of taxable, tangible, personal property, the performance of a taxable service, or the furnishing or preparation of food, drinks, or meal. I think this is a basic idea that most people understand. They, We learn it kind of in Tax 101, what is a sale, and most things that are for an item or good or service is taxable. So this is kind of just a side-by-side. The tax rate is the percentage of purchase price that is subject to tax. So like we saw before, in Massachusetts, the tax rate is 6.25, 6.25%. So for every dollar, an extra 6.25% of that dollar is taxed. And then, so taxable item, again, property, goods, services that are subject to tax are taxable items. This can often be called the tax base, the base of what is taxed. And that is where tax statutes often start as to what is the base. So we can look at a couple different ways these sales tax statutes are created. There's usually two approaches to the sales tax statutes. One is that it subjects everything to a sales tax and enumerates or lines out those that are exempt, or completely the opposite. It enumerates or lines up the sales that are subject to sales tax and persons that are exempt from the tax. So the former, Illinois, is an example of the former method, and Texas is the latter. So Texas would say which ones are subject to the tax and then say what is exempt. And Illinois would say everything is except for X, Y, and Z. So again, a lot of this has to do with state-by-state regulation, and that is something you're going to have to look at when you may go practice in a different state or help a client from a state over. There might be different tax consequences. In the bottom, you see a general rule is usually a sale of property is taxable unless specifically exempted. So while sales of services are generally exempt, unless enumerated as a taxable under statute. All right. So exemptions, these are just some basic ones. I'll line out, tangible and intangible property and services that are not taxable are known as the exemptions. I mean, that was pretty obvious, but I just wanted to say it. Entities like schools, again, is like what I was discussing, that's exempt from paying the tax when they buy a taxable item. So I think we've mentioned, basic income tax, Suffolk can buy items it needs and it'll be tax-free, or they can at least get it taken out later. So that is just the basic on exemptions, nothing really fancy. However, what can be a little trickier, depends on the situation, is the receipt price or sales price. So how much is being taxed by the sales tax? So you say you buy an item for $1. I was saying in Massachusetts that 6.25% of that whole dollar would get taxed. But what if there was a reason that the consideration, whether that dollar or something else, the whole dollar wasn't to be taxed? Let's say 75 cents. Well, that is what we'll get into. So receipt or sales prices, the basic definition of consideration is broad, but whether it's the dollar amount of the taxable good or if exchanged property was part of the deal, so what part of the value of that property exchanged is the consideration that's taxed or the sales receipt that's taxed. And so it definitely gets difficult when you start exchanging property instead of just paying a dollar amount for the good or service. So there are specific state laws defining what consideration is included with sales tax, and state laws are very specific on what they consider to be included or excluded from consideration. So the first thing is cash discounts. Very basic idea. Generally, the cash discounts are deducted. Generally cash discounts offered at the time of sale are deducted from the taxable sales price. So yes, I don't know why I got stumped on that. Yeah, so if it's a $1.25 item and there's just a discount and you only pay $1, you're only going to pay $1 for that item. You're only going to pay the tax on that dollar. You're not going to pay $1.25 tax instead. They don't want you to pay tax for consideration of an item you didn't have to pay for. So cash discounts. Hey guys, welcome to part 1 of the sales and bulk use tax presentation with Brian, Mike, and Francisco. I'm going to go over state and local, or I'm going to go over the introduction to sales tax in state and local taxation. So today I'm just going to kind of give you an introduction into sales tax and some exemptions and different things that do and do not qualify for sales tax. So the role of sales tax in fiscal policy is very important. For the states that do use a sales tax, it is crucial in raising revenue. 45 states and the District of Columbia impose a sales and use tax, and 10,000 plus local jurisdictions also impose a sales tax. The states that do not are Alaska, Delaware, Montana, New Hampshire, and Oregon. So you might have gone up to New Hampshire and been able to buy things tax-free because it is close enough to Boston, but I don't know if any of you have been to Alaska or Delaware or whatnot. But those are the 5 states that don't impose a sales tax. As I was saying, the income raised from the sales tax is extremely important to these states. In '95, it was roughly 35% of all the revenue, 35% of all the revenue that the states collected, which was close to $135 billion. And that was not including money raised by local governments. In some numbers I looked up for more recent times, seeing that was 20 years ago, it still hovers around 35%, 33%. It's, roughly a third of the state's revenue comes from sales tax. So that's a huge chunk that the state relies on every year. And for the states that don't have an income tax, that is even more important. So for a state like Massachusetts with an income tax, sure, roughly 35% of the income is from the sales tax. But for a state like Florida, Tennessee, and Texas that you see on the bottom of the screen, there is high 50s and even 60% of that state's revenue comes from the sales tax. So that's a huge number. Over half of the state's revenue comes from the money it collects on sales within its state. So an example here of a Texas law imposing a sales tax quotes it as this: a tax is imposed on each sale of a taxable item in this state. The sales tax rate is 6 1/4% of the sales price of the taxable item sold. Now, I believe that Massachusetts is the same, 6.25%. And of course, while they might be the same, each state does definitely vary. Like New York, I believe, has a higher sales tax than Massachusetts, like 8% or something like that. So this is important to know in the future so you can consider what tax implications might be depending from state to state. So what is the sales tax? I mean, we've already discussed it. I'm sure people get the general idea. But a sales tax is a transaction tax imposed on intrastate retail transactions. So sales that are within the state. And they are calculated as a percentage of the price paid for taxable goods and services. They can be imposed either on the seller or the purchaser. Although, as we know from, specific tax qualifications and such, certain businesses and all might be able to get a tax exempt number from the state. And that is why I have on the bottom how sometimes the purchaser may be exempt from the state sales tax. But usually the way that I'm sure we know it is we see it when us as the purchaser are having to pay that tax. So I have a few key terms that go along with the sales tax. I mean, they're pretty basic, 101, but we'll just kind of go over, look at it quick. What is a sale? The sale typically includes the following transactions when occurring for consideration. So whether you're transferring title or possession of property, the exchange of property, whether it's for money, exchanging property for money, exchanging property for property, giving money for property, performing a taxable service, or, food and drink, as we see taxes on our food receipts when we go out to eat, on the bill at the end, tax of $3 or $4 in tax. So that's usually what a sale typically includes, is the basic, exchanging goods or services. So a little left and right. So the tax rate I have on the left here, tax rate is the percentage of the purchase price that is subject to tax. So like in Massachusetts, again, 6.25%. That let's say out of $1. So out of that $1, 6.25% of that dollar is added on as the tax you pay. Taxable item we've been over as well, and we've talked about in the past in other tax courses, guys. Property, goods, and services that are subject to tax or taxable items, obviously. Often that's called the tax base, where the tax statutes start. The tax base is what is the bottom line amount that we start taxing at. So like I said, $1 candy bar. The tax base for that $1 candy bar is $1. But depending on different exemptions, that can change. But we'll get to that a little later in the presentation. Just quickly, I'd like to look at how these sales tax statutes that are different per state are designed. There are two approaches to sales tax statute making. One is to subject all to sales tax and list out those that are exempt, or enumerate the sales that are subject to sales tax, list out everything that is subject to a sales tax, and the persons that are exempt from the tax. Now, it would seem like the first one, the former, is easier. Everything's taxable except for these, and you put out a nice list of what's not. But some things, want to be more specific, maybe more accurate. So, like I said, every state can be different. Illinois is an example of the first approach I have on the slide, while Texas is an example of the latter approach. So it just shows how states can definitely differ. And of course, there's 50 of them, so you'll find a lot of them, different groups of ideas. So, as I said before, there are exemptions. Anything that's not taxable is known as an exemption, more or less. So somehow an item or an amount of an item isn't taxable, then that's an exemption to the statute or the rule for the sales tax statute in that state. I kind of mentioned before, sometimes purchasers won't have to pay a tax, and that might be when the purchaser, such as an entity, a school, can be exempt from paying tax when they buy taxable items. The receipt or sales price is the amount of value expressed in money or otherwise received for the taxable goods or services. A very basic definition. I know in contracts you go over consideration to begin with, and it's either the dollar amount or the value of exchanged taxable property or services, or in exchange for property for anything of value. But like I said, it's very broad, but it's pretty much, like I said, if you pay $1 for a candy bar, that dollar is the sales price, or it's the value that was paid. If it's 75 cents, that's the value. That's the sales price that is paid. However, these sales prices may change or may have deductions. They may have just different things depending on the state's definition of consideration. And of course, they often include, different exemptions and all, which I will be going over. So a cash discount, that is deducted from the taxable sales price. And that's, the basic idea behind a cash discount just being deducted is you're paying that amount, and that's it. So instead of $1, the candy bar is on sale for 75. Cash discount, sure, 75 is what was paid. So you're not going to pay a tax on $1 worth of a candy bar just because you paid 75 and they want the extra change. Usually it's whatever the consideration was given in cash is what you pay tax on. A different form of analyzing the sales price is if you get something in trade, volume, employee, or wholesale discount. These discounts are usually applied at the time of the sale, and because of that, it results in a reduced sales price. And, you know, again, you're only paying so much for this item, but you're paying it straight up, and it's applied at the time of sale, not later. So instead of getting 100 boxes of Cheerios for $100, you're getting 100 boxes of Cheerios for $50, but you are still only going to pay tax on the 50. You know, that's a basic discount that you can receive. That's usually, you're not taxed extra, almost like a punishment for getting a discount. Another type of discount that can be seen is what is called the early payment discount. These are discounts given for prompt payment of a bill, and some states do provide specific treatment, while others do not. So often, if early payment discounts are given, they're amended later because the vendor, you know, the vendor might not have known you were going to pay early. So that might not be something that they initially counted on happening. So it's often, if they do amend it later, we sold this for 75. Oh, but he paid before interest hit, so he only paid me 65, but I registered as 75. You have to amend for that $10 later. But I mean, some states don't care one way or another, and the original price is what you have to pay the tax on. So it really, this is a big one that depends on the state. So some states, yeah, they're just like, it's great you paid your bill early, but you still paid the amount, so pay tax. One that a lot of people might be familiar with, actually, is vendor coupons. These vendor coupons, you know, I worked at a grocery store. I saw them all the time. Vendor coupons are deductible, typically, in computing taxable sales price. Similarly, if a vendor marks down its merchandise, sales tax should only be due on the reduced price. So this is a vendor coupon, say Stop and Shop has a coupon out for 50 cents off. Similar to store coupons, you basically, the store's only getting the discounted price, you're paying the discounted price. Again, why pay the tax on the higher price that you didn't pay? So it, you know, like it says in the bottom, it's like a store coupon. Retailers often give them, and they absorb the cost of the discount. So North Carolina is a state that does apply this principle of not paying the extra tax. You only pay the tax on what the item cost. So that is a vendor coupon. It's beneficial to you. You reduce the item, and you pay the reduced price tax. Manufacturer coupons, they're a little different because they represent a reimbursement to the vendor. So the manufacturer gets the coupon from the vendor, and they give the vendor their money back. In this situation, a deduction is not allowed. You still pay the tax on the full price because both the customer and the vendor are still getting their money or their good. So sure, they're taking $1 off an item they bought, but at the end of the day, the vendor's still collecting from the manufacturer. Once the coupon's redeemed, the person's getting their $1 off. This can be also tricky when a vendor offers to double manufacturer's coupons. When they do this, the tax is typically not imposed on the double amount, because then that goes back to the vendor coupon rule, where when the vendor's willing to take the money off, you do not pay as the purchaser tax on that $1. That was kind of like a gift from the vendor, but the $1 that came from the manufacturer is still technically reimbursement for the item, so the tax is still paid even though the amount was deducted. Like I said before, you go to a grocery store with coupons on food, you won't see it because food isn't taxed. But say you go to the grocery store and you're buying your toilet paper or something and you use a coupon for $1 off. This is where you'll see it. And a lot of times, computers now at the grocery, not a lot of times, all the times now, computers at the grocery store automatically know and don't deduct what they need to in the final total. So you don't have to worry about doing the math for yourself. New York and California do have extra rules for manufacturers' coupons. New York, when a vendor doubles the coupon, taxes due upon the doubled value. They're just like, nope, pay the tax on everything. That's what you got to do. And in California, if you get a coupon that says get a free item, tax is due on the free item because the vendor is still getting reimbursed. So still the vendor had to buy the item. Still there was a sale at one way or another. So a free item coupon doesn't get you the item for free. Someone's still chalking up the tax. And in New York, even if you double all the coupons you want, you have to pay the tax on them. So definitely different. Definitely, you got to keep an eye on it. You might be paying a few cents more here or there if you go out of state, and you might have never known. So, Mass Regulation Code, Title 830, Section 64, H.1.4. Taxable sales price may be reduced by the amount of a manufacturer or vendor coupon if the coupon reduces the sale price at the time of purchase. The vendor's coupons are deductible, regardless of whether the vendor is reimbursed by the manufacturer, supplier, or distributor. So, this is what I saw when I was at the grocery store. Even a manufacturer coupon in Mass, you do not have to pay tax. So like what I told you before, does not apply to Massachusetts. Massachusetts has its own specific way of handling manufacturers' coupons. But vendors who double the amount of manufacturer's coupon should collect sales tax on the discounted price of the item, regardless of the amount of reimbursement for the coupon. So vendors still collect when they double coupons only for the discounted price. So they do not put the tax on the purchaser. And this is policy-wise, it promotes stores to do double manufacturers coupons and for people to use them because the store can lure in more customers, the people get a bigger discount without paying tax on it, and it helps increase sales. So these two rules in the Mass regulation is very purchaser-friendly and, store-friendly in a way, to help keep sales up and keep people coming in the stores and desire to use coupons. So another type of thing that can affect the final sales price is vouchers from a third-party discount company, the Groupon and all that. I had never thought about that till reading and researching this, but sales price retailers include their gross receipts depending on whether the vouchers are deemable for a specific service or product or a specific dollar value. So, what does that mean? The best way to describe it would be in this example. Missouri requires a retailer to include gross receipts for the price actually paid for a redeemable specific service or product. And their example is a 1-month yoga class for $29, let's say, instead of it being $49. You only have to you only have to pay tax on the $29. But if it's a full face voucher for a specific value, it's $50 worth of food at a restaurant, you have to pay tax on the full value. So if it's for a dollar amount, you're going to pay tax on that dollar amount. And that is why I claimed. So this is more on the retailer side of things again. Like that yoga class, they don't have to put into their gross receipts the $49 yoga classes. They only have to put $29 because that's what was paid for, and that's that. And the food, you have to put in the dollar amount because it's pretty much just an equivalent of $1. So this is an example of the two ways like a Groupon coupon would affect retailers' gross receipts at the end of the month. Gross receipts, I don't think I mentioned, but that would be where the retailer shows what they sold in their amount and what tax they then owe back to the state. Trade-ins. Trade-ins can also affect the bottom line amount that was paid. There are different methods to deal with trade-ins depending on the state, and that's a repetition for many of the things I'm going over today. But this one really is different depending on the state. You know, Missouri, New Jersey, New York, they don't put sales tax on the value of an automobile that is traded in when in connection with the purchase of another automobile. California imposes a tax on the value of the trade-in. However, Texas does not reduce sales price by the value of the tangible personal property taken in trade. Another method that can be used is a credit, which is used in Maine. In Maine, credit is allowed for the items traded in the same category itemized in the statute, so automobile or automobile. So in Maine, if you trade in a car, it doesn't reduce the sales tax at the time of purchasing the car, but it at least gives you a credit that you can put on your sales tax form at the end of the year. So as you see, they're all very different, and they change state by state. Another thing that can change is rebates. States flip-flop on rebates as well, whether it should be included as part of the taxable purchase price or not. A common way of handling rebates is to reduce the sales price by the rebate amount if it was reduced at the time of sale. So when the purchase is made, if you use a rebate, you can reduce the sales price. That is tax. However, it's after the tax is based on the full purchase price. So an example of this is in Illinois. Illinois has an energy rebate program. Seller provides discount and is not reimbursed. Only the discounted amount is subject to tax. So this is getting it ahead of time. Energy rebate. You get a better boiler, and they're going to give you a discount. So, especially because the seller is not getting, they still have to pay the tax, and they're not reimbursed for it. That way, it's only subject to the discounted tax. But a better one for understanding, I think, is the cell phone sales rebate example. So if the cell phone service is giving discounts on all phones, let me just read it straight. If money received from cellular service providers is equivalent to discounts given on cellular phone sales, then it is subject to sales tax. So it's the same phone, it's always getting a discount of $100, you have to pay tax on the whole thing. But if the compensation is from service providers and it's based on a percentage of how many new phones they activated this month to next month, then it is not subject to sales tax because it's always varying, it's up and down. It's not a straight number for every item, it fluctuates. So the Illinois Energy Rebate Program, the Illinois Cellular Phone Sales Rebate Program are two examples of rebates and how it can or cannot be taxed for the total or rebate amount. So if you need help with that, just look at this slide again. These examples should help clarify rebates for you. Credit card fees. Every retailer usually or vendor has to pay them by using credit cards to pay for their bills at their store. This reduces the amount of vendors reimbursed on their sale because they are paying a fee, but that is, I guess it's a fee that you impose on yourself by choosing to accept credit cards. So at the end of the day, that's their choice, and in general, most states, it's not deductible, the fees that are imposed on the vendor from a credit card. So you would hope that you could take that off. You don't pay tax on that much and say, or reduce the taxes you pay because you had to pay a credit card fee, but that's just not the case. You have to pay even the credit card fee and without deduction. Check cashing fee, more or less just saying the same thing here, but I'll go over it quick. Similar to credit card fee, and it's a processing fee imposed on the vendor, but it is not deducted typically. Now, charges for shipping, handling, delivery, and postage. So, should these be taxed? And this is a little detailed. Sometimes taxation of charges for shipping and handling vary on the shipping method. Sometimes it's simply if you use U.S. mail, then it's not taxed. And sometimes if you use another provider, it is taxed. Or intent of the parties at time of sale. So we'll get more into that later if it was expected or unexpected. But this California regulation, in general, tax does not apply to separately stated charges for transportation of property from a retailer to a purchaser. So if you had a contract made and you specifically had the item was this much, the postage and handling's this much, only the portion that said postage may be excluded from the tax. But that does at least allow some form of exclusion because you want to pay tax on the item, not on the shipping to get there. Although another argument could be is that is a service, the delivering of it to you. So in Indiana, letter of finding in 2000 had the department finding different ways in which shipping was and was not taxable. Now this is a little tricky, but FOB, free on board shipping point, and the title to the goods passing to the buyer at the shipping point. And so as you see, delivery charge separately stated, they're all separately stated, the first three. And if it's separately stated with where the title will pass to the buyer, then it's taxable because you know. But if the title passing point is at the origin, it's not taxable. Or if it's not established, it's not taxable. But if back to the California law, if it's included with the purchase price and it's not separate, delivery charges are taxable. So this is like 4 separate moments, and it all depends on where the title to the good passes from the buyer to the buyer from the seller. One case that we have that has issue with the delivery stuff is Southern Ready Mix Company versus Missouri Department Director of Revenue. In this case, Missouri Supreme Court ruled that delivery costs in a purchase intended to be part of a sale are subject to tax. This also made the delivery costs unable to be deducted from gross receipts. So you paid tax on the delivery in this case. And it was similar to a statute in Missouri where sales tax is imposed on gross receipts. And those usually include sales price plus certain related services. And of course, the court deemed certain related services to be shipping costs. Another case, Associated Bearings Company versus Missouri Department of Revenue, looked at, it was determining whether there should be a tax imposed on delivery charges from ABC when a customer ordered goods from them rather than from the supplier. So what happened was the customer could order straight from the supplier, and that was it, or they could order from ABC. ABC would get the item from the supplier, then ship it to the customer, but the ABC would put a shipping and handling fee in for being the middleman. And in order to keep business, the policy behind this rule was that it was not part of the sales price, the delivery charges, so it was not taxed. Because simply the seller was trying to offset the delivery costs from the supplier. And so they flip-flopped here, and I think the reason for it was because they wanted to support ABC and businesses and not promoting a customer going around the local businesses just to avoid tax on the delivery fee. So that, sometimes there's policy and political reasons behind it, this one being getting the tax not to be paid to support businesses. But nowadays, there's been a change. I have the little note at the bottom. Even with an option for pickup or delivery, Missouri will tax delivery fees from retail catalogs, and that's more recent times from the Missouri case, from what I read. So it's changing. I mean, more and more people now order offline with shipping, so who knows how that'll change, if another case happens to get brought up at some point. The Massachusetts Uniform Commercial Code. The transportation charges are excluded from the taxable sales price only if the delivery takes place after the sale and only if the transportation charges are separately stated. So this from other states would lead me to believe, separate your, when you write a contract or a sale, make your shipping charges separate. A good chance that you'll be able to not pay tax on it or get it deducted if you do so ahead of time. New York, they just want you to pay. So whether it's the vendor or through a third party, they just put it right under the definition of taxable receipt. It includes shipping. So in New York, doesn't matter, So if you go to New York, then don't worry about it. Nagel versus Wagner. The Illinois court ruled basically that transportation charges are subject to tax when the sale and transportation of an item are failed to be shown as two separate transactions that were also negotiated separately. So again, the idea of having two contracts or two invoices, one for the item, one for the shipping. That way the shipping will not be taxed or can be at least reimbursed later or deducted at the end. So really the only time is New York, where they said, nope, you got to pay tax on the shipping costs too. But it seems to be a safe bet, just separate the two and you should be okay. Personal property, generally tax applies to the full amount paid to personal property. The same goes for leased property. These are just a few definitions of things at the end, obviously, but personal property tax applies to the full amount, just about always. A miscellaneous charge, like a late fee or penalty, is typically not subject to tax because they're not part of the original consideration. These fees are not for the sale of tangible property, so there's no tax. That's pretty obvious. I'm not paying this amount for the item. It's because I failed to pay for the item properly and in an orderly fashion the first time. So no tax. And we've kind of gone through the whole vendor purchaser item, but just to prep you for the next section, a vendor. Generally, a vendor includes a person maintaining a business, making sales of tangible personal property or taxable services, and who solicits sales by employees, independent contractors, or other representatives. Also, in some states, they can be called sellers, peddlers, retailers. So a vendor typically should make sense, the definition. Some states may require a person to exceed specified sales over a 12-month period. It's important to know who is within the statutory definition of a vendor because they are liable for the paying or collecting of taxes. And if you have someone as your client, you better know if they would be considered a vendor because you might need to know during the case their extra tax implications. But like I said in the second to last asterisk there, some states may require a person to exceed number of sales. I know California or a state like that requires like at least $50,000 in sales in the first 12 months plus, there's a certain amount and you just have to make sure you know what the state's requirement is, if any at all. And then finally, the last definitions we're going to go over in this part today is the purchaser, the other side of the coin. Purchaser is a person, including an entity, created by a law such as a corporation. You purchase goods or services that are taxable for consideration. Vendees, users, consumers, that's another name for any of them. And, you as a person going to the store, obviously, purchasing something, you're a purchaser. And the purchased goods are taxable for the consideration you paid. There's, like Connecticut, just below us, some states, it provides limited exemptions when it's between related entities, and this is rare. Connecticut is one extreme example. Usually, taxes are aimed towards the form of the transaction over the substance. So if two entities are usually doing the same item for each other, typically they're not. Typically, the tax is aimed at the fact that there's a transaction at all, not because they're the same item. It doesn't count. So, like I said, it's rare that it's sometimes exempt just because it's the same thing. So I would say that that's an outlier. And, you know, an example, minus a specific exemption, a corporation will be required to collect tax on sales or rentals to an affiliated entity. So again, it's an extreme example, or extreme outlier. But just to know, you might get lucky. There might be some sale between your two companies someday that it counts as related and you're in the right state and you don't have to pay tax on it. But hopefully that was a good introduction into sales tax, guys. And I will let Mike take over for part 2 in use tax. Thank you for listening to our presentation.